The Financial Times has an interesting story discussing the impact of recent U.S. tariffs on Chinese exports to the U.S. Donald Trump's first sally in the skirmish was to impose a 25% tariff on 818 Chinese product lines, including electrical equipment, machinery and vehicles, in July 2018. This wave purportedly covered an annual $34 billion of Chinese exports, although analysts at Standard Chartered calculated they amounted to just $16.4 billion in 2017. Mr. Trump then followed up with a 25% levy on a further $16 billion of annual U.S. imports in August and slapped a 10% tariff on another $200 billion of products, a figure that is due to rise to 25% in April if the two countries are unable to resolve the dispute by then. Standard Chartered's analysis of the initial tranche of targeted goods, the $34 billion list, found that China's U.S.-bound exports of the 818 products fell 27% in August-October 2018 compared with the same period a year earlier. China accounted for just 6.9% of U.S. imports of these 818 lines, down from an average of 10.4% during the August to October periods of 2015 to 17. It seems that the recent tariffs have reduced Chinese exports of the specific goods being targeted, but what about overall Chinese exports? This is despite China's overall exports to the U.S. appearing to have held up well last year, amid expectations they hit a record $550 billion, up from $505 billion in 2017. That's a bit odd, unless you think about what sort of factors determine trade balances. Trade experts believe that tariffs have relative little impact on overall trade balances, which reflect saving, investment imbalances. So why did Chinese exports hold up once the tariffs were applied? The imposition of tariffs on Chinese goods may have contributed to a sharp fall in the foreign exchange value of the yuan during the second half of 2018. Note that on this graph a bigger number means a weaker yuan. The vast majority of Chinese exports were not impacted by the 25% tariff. Either there was a 10% tariff, or no tariff at all. Thus the roughly 10% depreciation of the Chinese yuan prevented the 10% tariff from having much impact on $200 billion worth of exports, and actually boosted Chinese exports of the $300 billion worth of goods that were not hit with any tariff. This is not to say that a sufficiently high set of tariffs would not impact U.S.-China trade. It would, but the impact can be very complex. Tariffs might also reduce U.S. exports, leaving the trade balance unaffected. The weaker yuan might boost Chinese exports to third parties, while reducing Chinese exports to the U.S. There are lots of possibilities. The key point is that these policies need to be examined from what economists call a general equilibrium framework, which means considering all of the unintended side effects on other markets and other countries.